Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So last three videos I have completely explained you about the CVP analysis, break-even analysis, break-even point, contribution, all the terms used, marginal costing and the application of marginal costing by the management to take the decisions. All these things I have already uploaded in the last three videos. Hope you have completely watched all the videos and got the complete command on the different concepts which are used in CVP analysis and the formulas. The problems are based on the formulas which I have already explained in the last video. So the problems you can solve only if you are perfect on the formulas. So I suggest you, first of all, watch the first three videos, theory videos completely, then only you can be able to understand the problems. If you have not watched, I suggest you go to the playlist of my channel. Select the subject accounting for management. Select the videos of CVP analysis. Watch the videos, be perfect on the formulas, then you can come to these problems. Now, I'm going to start the problems on CVP analysis. In this video, first four problems I'm going to explain you. So before watching the video, you must take a printout of the problems which I have given in the link under my description. Always keep ready the problems. Without having the problems, you cannot understand the explanation. Take the screenshot of the first four problems, then I'll explain all the points in detail. Now, see the first problem. From the following details, find out contribution per unit, break-even point, margin of safety, profit, and volume of sales to earn a profit of rupees 24,000. So these five questions are asked. Now, the information given is units sold 20,000, total sales 60,000, total variable cost 30,000, fixed cost 18,000. This is the complete problem. From the data given, first of all, we calculate what is the selling price per unit and what is the variable cost per unit. See the solution carefully. Selling price per unit, the formula is total sales divided by units sold. In the problem, total sales are 60,000, units sold are 20,000. So 60,000 by 20,000 rupees, 3 per unit, that is a selling price per unit. Now variable cost per unit, the formula is total variable cost divided by units sold. So here total variable cost is 30,000 and units sold 20,000. 30,000 by 20,000, 1.5. So we got selling price per unit, variable cost per unit. The first question, it is asking you to calculate contribution per unit. The formula for contribution per unit is selling price per unit minus variable cost per unit. All these things already I have explained in the last videos. The formulas for contribution, PV ratio, BEP, margin of safety, everything I have explained. You have to remember. And while watching the video, I suggest you always keep a notebook, calculator, pen beside you. When I say something, immediately you should write it down. Then only you can be able to understand. So selling price per unit minus variable cost per unit. Selling price 3 rupees, variable cost 1.5. So 3 minus 1.5. So 1 rupee 50 paisa is the contribution per unit. First question completed. Second, break-even point, BEP. The break-even point can be calculated in units and also in rupees. So first we calculate BEP in units. The break-even point in units, the formula is fixed cost divided by contribution per unit, or we can say fixed cost divided by selling price per unit minus variable cost per unit. So here already contribution per unit we have. So we'll take fixed cost. The fixed cost is given in the problem 18,000. So fixed cost is 18,000, contribution per unit 1.5. So 18,000 by 1.5, 12,000 units. That is the BEP. Now, if you want to calculate BEP in rupees also, so whatever BEP in units you got, multiply with the selling price per unit. So how many units BEP we got? 12,000. So multiply 12,000 into 3. Selling price per unit is 3. So 12,000 into 3, 36,000 rupees is the B. Next, it is asking you C point to calculate margin of safety. The formula for margin of safety already I explained in the last video. That is actual sales minus break-even sales. The formula for margin of safety is actual sales minus break-even. The actual sales are given in the problem 60,000 and break-even sales just now we got 36,000. So 60,000 minus 36,000, 24,000 is the margin of safety. Next question is profit. Profit we have to calculate. Profit is equal to, I think I have not calculated profit there. I forgot to calculate directly. I have taken the last one. So profit. To calculate profit we can apply that D point. And this is the E point. Totally 5 questions are asked. I forgot to write the D point, profit. So profit is equal to, how we can calculate profit? Margin of safety, one more formula is there, profit by PV ratio. Right? Profit by PV ratio. This is the formula we can apply to calculate profit. Or simply we can find out profit like this also instead of, because PV ratio we don't have. We don't have the PV ratio here. So without PV ratio also we can calculate the profit. How? Total sales. Total sales are 60,000. From total sales I subtract variable cost. The variable cost is 30,000. So 60,000 minus 30,000, you will get 30,000 contribution. This is called contribution. From contribution, I subtract the fixed cost. The fixed cost is 18,000. Deduct 18,000 will get 12,000. This 12,000 is the profit. So D point, it is asking you to calculate the profit. I have not calculated here. I forgot. Now I have written here. There are 2 methods of calculating the profit. The first method is this one, sales minus variable cost, you will get the contribution. From contribution, subtract the fixed cost, we will get the profit. Or alternatively, we can apply margin of safety is equal to profit by PV ratio. Margin of safety already we have here 24,000. Profit we have to find out, PV ratio also we have to calculate. So without calculating PV ratio, we can calculate profit like this. Next, E point. Volume of sales to earn a profit of rupees 24,000. Volume of sales means number of units required to be sold to earn a desired profit of 24,000. So there is a formula in marginal costing regarding this volume of sales. The number of units required to be sold to earn a desired profit. The formula is fixed cost plus desired profit divided by selling price per unit minus variable cost per unit. Or contribution per unit also you can take in the denominator. The numerator fixed cost plus desired profit. Fixed cost is given in the problem 18,000. So in place of fixed cost 18,000. Desired profit, how much we want to earn? 24,000. 24,000 is the desired profit. Divided by selling price 3 rupees, variable cost 1.5. So 3 minus 1.5 is 1. 42,000 by 1.5 you will get 28,000 units. By selling 28,000 units, we can get a desired profit of 24,000. That's it. This is the end of problem number 1. Now I am going to explain you problem number 2. You are given the following data for the year 2016 of XYZ Limited. Variable cost 6 lakh, fixed cost 3 lakh, net profit 1 lakh, total 10 lakh. See here, variable cost and fixed cost. If you add up, you will get the total cost. To total cost, if you add the profit 1 lakh to sales, that 10 lakh rupees is given, it is nothing but sales. Now, percentage is given. That means the variable cost are 60% of sales. Fixed cost are 30% of sales. Net profit is 10% of sales. Actually, we don't require this percentage. Now, find out the break-even point, PV ratio and margin of safety. So, in the problem, 3 questions it is asking. First of all, we need to calculate BP. The formula for BP, different formulas are there. If you want BP in units, fixed cost divided by contribution per unit. If you want BP in rupees, fixed cost by PV ratio. But we don't have the PV ratio. One more formula is there, fixed cost into sales, F into S divided by S minus V. This is also one of the formula for calculating BP. So I am applying the formula F into S by S minus V. Fixed cost into sales divided by sales minus variable cost. Sales are given in the, fixed cost is given in the problem 3 lakh and sales are given 10 lakh. So 3 lakh into 10 lakh divided by sales minus variable cost 10 lakh minus 6 lakh. The first denominator 10 lakh minus 6 lakh, you will get 4 lakh. Numerator 3 lakh into 10 lakh. So what I will do is I will cancel the 5 zeros in the denominator. In this 5 zeros I have cancelled, this 5 zeros I have cancelled. So 10 lakh into 3 divided by 4, you will get 7,50,000. The first question we have completed, that is break-even point, 7,50,000. Secondly, it is asking you to calculate PV ratio, profit volume ratio, C by S. C by S into 100. So in place of C, I can write S minus V. There are two formulas for contribution. Contribution is equal to sales minus variable cost, or contribution is equal to fixed cost plus profit. Here I am taking C is equal to S minus V by S. Sales are 10 lakh, variable cost is 6 lakh divided by 10 lakh. So 10 lakh minus 6 lakh, you will get 4 lakh. So 4 lakh by 10 lakh into 100, 40%. That is the PV ratio. Second question completed. Third question, MOS, margin of safety. Very simple. Actual sales minus break-even sales. The actual sales are given in the problem 10 lakh. And break-even sales, just now we have calculated 7,50,000. So 10 lakh minus 7,50,000, 2,50,000 is the margin of safety. That's all. Second problem completed. Now I am coming to the third problem. The following information relates to sales and profit and loss of an article for July and August 2015. So we are given the data for July and August. So two period data is given, one period July, one period August. So what information is given? In the month of August, there is a profit of 3,000. In the month of July, there is a loss of 2,400. That means in the month of July, there is a loss. In the month of August, there is a profit. And sales are in July 38,000, in August 65,000. Now calculate PV ratio, fixed cost, profit or loss at a sales of 46,000 and sales to earn a profit of 5,000. So totally 4 questions are asked. One by one we will attempt. The first question is PV ratio. See here, PV ratio, the formula is contribution by sales. But if two period data is given, we can conveniently apply the formula PV ratio is equal to change in profit by change in sales into 100. So this change in profit by change in sales into 100, this formula will be applied only when two period data is given. Here two period data is given. That's why I am applying the formula PV ratio is equal to change in profit by change in sales into 100. How much is the change in profit? In the month of July, there is a loss of 2,400. And in the month of August, there is a profit of 3,000. That means we have recovered the cost, then we have earned the profit of 3,000. The total change in profit from July to August is 2,400 plus 3,000, 5,200, 5,400. 2,400 plus 3,000. 5,400 is the change in profit from July to August. Be careful regarding here. Change in profit. First month there is a loss. Second month there is a profit. So we have converted from loss to profit. The total change is 5,400. And change in sales. In the month of July the sales are 38,000. And in the month of August it is 65,000. So how much is increased? How much is changed? 65 minus 38, 27,000. So we got the change in profit, we got the change in sales. So 5,400 change in profit, 27,000 change in sales. 5,400 by 27,000 into 100, 20%. That is the PV ratio. Secondly, it is asking you to calculate the fixed cost. For calculating fixed cost, I take the help of PV ratio. By using the PV ratio, we can easily calculate the fixed cost. We know the formula for PV ratio is C by S, contribution by sales. And contribution, we can take F plus P. We can take S minus V, or we can take F plus P. But here we require fixed cost. That's why I am taking F plus P by S. In place of C, I am taking F plus P, fixed cost plus profit divided by sales. Now I am substituting the values. PV ratio is 20%, 0.2 is equal to fixed cost we don't have, but profit and sales are there. Take the profit and sales of any one of the month. Here I am taking the month of August. There is a profit of 3,000 and the sales of August are 65,000. So here I am taking in place of profit 3,000, in place of sales 65,000. Now I make cross multiplication. F plus 3,000 into 1 is F plus 3,000 is equal to 0.2 into 65,000. You will get 13,000. Now equation we got. On LHS we have F plus 3,000, RHS 13,000. Now keep F on LHS, bring the 3,000 to RHS. So this plus 3,000 will become minus 3,000. 13,000 minus 3,000, fixed cost is 10,000. So 2 bits I have completed. Now the third bit is profit or loss at a sales of 46,000. Profit or loss at a sales of rupees 46,000. Again I take the help of PV ratio, because by using PV ratio, it is a multi-purpose formula. Many things we can calculate by using PV ratio. So PV ratio C by S. Now I require profit. Profit I need. Sales are given 46,000. So again apply the formula C by S. In place of C I am writing F plus P. In place of C I am writing F plus P. Now PV ratio already we got it 20%, 0.2. 20%, 0.2 is equal to F, fixed cost. The fixed cost 10,000 just now we have calculated. Profit we don't have, we have to calculate. And sales are given here 46,000. 46,000. So in the complete equation, one unknown variable is the P. That we have to calculate. Now 10,000 plus P into 1 is equal to 10,000 plus P. 0.2 into 46,000 is 9,200. So keep P on LHS and bring 10,000 to RHS. So plus 10,000 will become minus 10,000. So 9,200 minus 10,000, you will get minus 800. Negative profit. Negative profit means loss. So there is a loss of 800 rupees. Simply, when the sales are 46,000, the firm will incur a loss of 800 rupees. That's all. One more last bit is there, that is D. Sales to earn a profit of 5,000. How much sales we have to make in order to earn a profit of rupees 5,000? So there is a formula in the marginal costing that sales required to earn a profit, desired profit, is equal to fixed cost plus desired profit divided by PV ratio. Note it down. Whenever you come across a new formula, new thing, immediately you should write it down. Then only you can remember. So first time we are applying the formula. Sales required to earn a desired profit. Fixed cost plus desired profit by PV ratio. The fixed cost already we have calculated 10,000 here. And desired profit is given in the problem 5,000. And PV ratio already we have calculated 20%, 0.2. 20%. So 10,000 plus 5,000, 15,000 by 0.2 is 75,000 rupees. So sales required is 75,000. If we sell 75,000 worth of goods, we'll get a profit of 5,000. That's it. So 3 problems I've explained. Now last, 4th problem. From the following particulars, calculate BP, break-even point. Sales are given 4 lakh, variable cost 2,40,000, fixed cost 60,000. You are required to calculate the following. new BEP if sales is reduced by 5%, new BEP if variable cost is increased by 5%, new BEP if fixed cost is increased by 5%. So totally 4 times we have to calculate BEP. Without any change, what is the BEP? First of all, we have to calculate. See here, BEP. The formula is fixed cost by PV ratio. The PV ratio we are not given. So first of all, we better calculate PV ratio. PV ratio is C by S. S minus V by S. Sales minus variable cost. Sales are given 4 lakh. Variable cost 2,40,000 divided by 4 lakh into 100. 40% is the PV ratio. Now simply substitute PV ratio in BEP formula. The BEP is fixed cost by PV ratio. Fixed cost is given in the problem 60,000. 60,000 divided by 0.4, 1,50,000 is the BEP. So without any change, we got the break-even point 1,50,000. Now, one by one we'll make the changes. A point. New BEP if sales are reduced by 5%. If sales are reduced by 5%, no change in variable cost, no change in fixed cost. Only sales are changing. Earlier, the sales was 4 lakh. Now 5% decrease. So 4 lakh minus 5%, you will get 3,80,000. Now new sales are 3,80,000. When sales changed, PV ratio will also change. What is the PV ratio? See here. New PV ratio is S minus V by S into 100. New sales are 3,80,000 minus variable cost old, same, 2,40,000 divided by 3,80,000 into 100. 36.84 is the PV ratio. Now BEP. BEP formula fixed cost by PV ratio. There is no change in fixed cost. Fixed cost is 60,000, whatever is given in the problem. No change in fixed cost. So 60,000 divided by 36.84%. If you convert the percentage into fraction, simply divide 36.84 divided by 100. You will get 0.3684. So you can take 36.84% or you can take 0.3684. Both means same. So denominator, you can take 36.84% or in fraction you can take 0.3684. You will get the same answer. So 60,000 divided by 0.3684, 1,62,866. That is the new break-even point. Now, B point. New break-even point if variable cost is increased by 5%. No change in sales, no change in fixed cost. Only variable cost is increased by 5%. What was the old variable cost? Old variable cost was 2,40,000. Now 2,40,000 plus 5%. You will get 2,52,000. This is the new variable cost. Now new PV ratio. PV ratio formula S minus V by S. Sales are remaining same, 4 lakh. Variable cost is changed. 2,52,000 divided by 4 lakh into 100. 37% is the new PV ratio. We can take 37% or we can take 0.37. Both means same. The new BEP. Fixed cost. No change in fixed cost. 60,000 divided by 0.37. You will get 1,62,162. This is a new break-even point. Last one. C point. New BEP if fixed cost is increased by 5%. Now we are changing the fixed cost. Keeping constant the sales and variable cost. Only fixed cost we are changing. Old fixed cost was 60,000. To this we add 5%. The new fixed cost will be 63,000. Now find out the BEP. BEP is equal to fixed cost to divide by PV ratio. New fixed cost. New fixed cost 63,000. And PV ratio is same. What is the PV ratio earlier? 40%. So 0.4. You will get 1,57,500 is the new break-even point. That's it. So in this first video on problems of CVP analysis, 4 problems I have explained in detail. If you want the perfect knowledge, watch the video once, twice, thrice. 3 times if you watch the same video and copy down or note down all the points, definitely you will get a good command on the concept of CVP analysis. So If you are satisfied with my lecture, give a like to the video, share my channel, subscribe, and by the super thanks which is given below my video. Inshallah, we will continue the next problem in the next video.